right, traders, we're on episode 6 and we've gone through a lot, but now we got to find the tickers to trade, right? We got to do the pre-market scanning, the watch list, the catalyst analysis. There's a lot to dive into here. What are we exactly looking for? Because you got to know the setups you're looking for. There's 6,000 tickers out there, right? There are a ton of tickers, so we got to narrow in that watch list a little bit. Josh, how do you go about that?
Well, again, like we talked about this probably a lot overall, is just defining what you want to look for every day, right? So as soon as I define that, I already know what I'm looking for day in, day out. Well, now that just determines what I'm going to trade. So really, the process of elimination happens every single morning. Going back to grade school, right? When the teacher was like, well, A through E, what's your answer? Well, go through process elimination. Maybe D is not the answer. Okay, A, that's not the answer. B, no. Okay, it's got to be either C or E here, right? And then you can then dive into C or E with a lot more concentration and define where your setup's at. And of course, that's such a fast process for me now. But every day I'm coming in, I'm looking at the top gainers, day one runners. Now maybe looking at day 2, day 3 as well, like yourself, but usually focused, I would say 75 to 80% of my small cap trades that I take would be first day runners. The first day I'm seeing them, whether it's the first time in a few months and I've seen them before, or the first time I've ever seen it. Like those big gap uppers, 50%, 80%, 100%. Yeah. Of course, even more than that's great. But that's generally what I'm looking for, and usually we'll get that too much of a gap up if you missed it. Like we've seen recently, we come into plays gone from 5 to 35 and now you're seeing it, it's sitting around 20. I usually don't like those plays as much. You usually miss the fun in the run. So I'll go find a play that hasn't quite made that run.
Yeah, there's a lot there. Like that play that goes from 5 to 35. Now I may be looking at the short, when on its way down. So it like Josh said, it just, what are you looking for? Josh may be looking for the day 1 runner. I like to look, like he said, for the day 2, 3 runner. But ultimately, you need some defining criteria. We're going to go over some of those metrics right now. But Josh, I remember when I first logged into Thinkorswim, which I've been using now forever, and I had no idea what I was looking at. I mean, I pulled that thing up and it just felt like, where do I even begin? So I was trying to reflect when doing this episode and look back when I first started. What did I need? What did I need to hear? Well, here's a few things that come to mind. A, you're going to need volume, guys. If a ticker has no volume, is flatlining, there's no money to be made. And now you can make money when a stock goes up, that 5 to 35, like Josh said. You can make money when the ticker goes down. On the short side, selling high, buying low, or buying low and selling high. But you need volume. That's one of the key metrics that you have to look for. And now for my strategy, I like to look for volume from previous days because I'm reacting to the move that's already happened. I want longs to be out of it at this point. I want the ticker to shoot up a couple days ago and just kind of stay there and not get any volume at this point, but it had volume a few days ago. I like to bleed it on down, and that's looking for abnormal volume relative to its average daily volume. So that's very important too. And we go over looking left to predict right all the time. Looking left, looking into the past to predict essentially the future, and that abnormal range is what you need. So where is its ticker usually trading at? And now it has an influx of volume, and now how is it trading? Because if it's around like it's just consolidation zone, its previous close, it hasn't moved in like months, years, no volume, then there's not really a trade there, right? It's a prediction trade. Like maybe you're taking a trade out of prediction. There's no volume. It's essentially a gamble, but we want to react. Reactionary trading is more so reacting to volume that is present versus trying to predict where tickers are going to go, because that starts leaning towards gambling. What are your thoughts on the volume, John?
Always got to have volume. Volume is, I've said for pretty much forever, volume equals action, action equals trades. And so you have volume, you can have action. If you have action, you can get some trades in. Again, that then goes back, like, of course, I'm so defined on finding your setup and trading that edge that you trade daily to a pretty high standard. And it's huge, though. You got to have volume. Now, there are some slower volume plays and a little bit lower volume that can possibly still get some good trades, but typically most trades and setups you're going to be looking for, you're going to need some sort of volume to move that ticker and in the direction you want. A lot of the time when you do have that slower volume with a low float play, because you do bring up float here, you have a low float, low volume play, it doesn't take much buying or selling either way to push that 10 point, because then you have to check the spread. What's the spread on it as well? Because on a low volume, low float play, there's going to be some spread on that bid and ask, whether it's 5 cents, 10 cents, 20 cents, and usually can be able to tell that by price action. It's at 10.20, all of a sudden it's at 10.42, it's back at 10.33, and now it's back at 10.41. Well, no, there's a spread. There's no way it's jumping in between all that without having some sort of a spread. Got to pay attention to that as well. And find your rhyme and rhythm to what you trade. If I look at a play that's up 20, 30%, I'm usually not trading that small cap ticker. Now, mid cap play, like we talked about earlier, which was like SMR, there's some mid cap plays. That's fine. We're doing good. We're moving pretty solid for a mid cap at that point. I can tell you as soon as I come in, that's one thing I'm always looking for is what's the gap up percentage, because generally speaking, then I know my profitability zone. Trades will be there. That typically happens at 50% plus.
So in the small cap space, as far as like the float goes, that percentage that you just touched on, and of course the catalyst, like what exactly are you looking for? Like for instance, if it has a decent catalyst, but it's only up 10-15%, are you interested at that point? Are you disinterested if it's like a very large float and it has, so how did the stars have to align for you?
Right, yeah. No, one of those things, the first thing I'm always looking at would be the gap up percentage. You know, that's the first thing I'll look at. And then after I look at the gap up percentage, while my brain is kind of charting it, because I've of course put it in my Thinkorswim. Of course, I had them forever. Great charting services. There's many great charting services out there, whether it's Webull has a good one, even Trade the Pool has a really good one, TradingView. But you got to find something where you can see charts well. So while I'm doing that on my charting service here, I'm also then clicking on the news, and I'm seeing what is the news, what's that catalyst that's pushing it. Well, and again, like I said, if it's only up 10-15%, very few and far between. And we had one actually in the last week that didn't run in pre-market. It ran after the bell. It was only up like 10-15%. Actually had a news, PR, and catalyst, but for some reason, all the other traders were on these other, all these other setups, all these other tickers trades. So you'll see that from time to time. But I'll tell you right out of the gate, if it's 5, 10, 15% and has a PR, it should, as I always say, it should have popped by now. I don't like trying to trade that initial spike, especially when it comes to pre-market. I like for the chart to build itself. Let a chart build up 20, 30, 40 minutes, and then start to use that chart at hand. Very few and far between will I just jump the gun and immediately trade just using past chart history. I like to not only look at that, look left, build my chart in, like I said, when I put the ticker in, then let some of that past chart history line up with what's working today. So now I know it's running technically sound because we're seeing past chart history levels work with today levels. So every trader essentially, or for the most part, is on the same page when trading that ticker.
Yeah. Now this is the episodes are on small caps, so I'm going to speak on fundamentals as far as small caps go, and usually they're not good. Even if they appear good, these companies, they have a rhyme and reason for what they're doing. They need the money, and so they're coming out with these fluff PRs to try to essentially get investors, and then they oftentimes will dilute them, coming out with offerings at some point. And so it's a tricky game in small cap land. I usually call fundamentals fundamentals in small cap land. I used to put a lot more emphasis on the fundamentals than I certainly do now. There are some PRs that I look at, but Josh, like you've probably seen this too. The quote, buy the rumor, sell the news. You can even have like a good PR come out and the ticker just dump. And it's because oftentimes these things are bought in anticipation of the news anyways, regardless. So you'll see the ticker slowly kind of like trending upwards as maybe insiders or institutions or whatever accumulating this ticker. So it's vexed in months ahead of time. And then the news comes out and they all dump into the retail investors when the news comes out. So ultimately, guys, we're trading the chart. We're trading the volume, the chart, price action, and that's essentially it. Knowing the risk on these things, not putting all our chips on the table with the news. The catalyst analysis can turn you into the paralysis by analysis. So you got to be careful of that. There are certain PRs, Josh, really good earning. The ticker is going to gravitate towards that intrinsic value. Of those plays, I'm more hesitant to short, like earnings plays, and maybe phase 3. Phase 3 trials, those are the best ones, right? In the phase 1, 2, 3, phase 3 says this is better than what's on the market, and that usually brings in a ton of hype. So there are a few headlines that I look at, and of course there could be partnerships with larger companies that get some hype behind them, but outside of that, I'm still shorting euphoria, selling high and buying low, selling high, buy low, and focus where the volume has been. Again, that we're looking for abnormalities. That's trading, right? We want to see above average volume because that creates above average range. And that range is where the money is made.
Yep. I'd add two catalysts to that. One would be trends, like we saw recently with the whole treasury, and someone has a 80 million, 100 million private placement, or you'll see the same PR where it happens for a play or 2 or 3 that go 800, 1,000, 1,500%. Well, next thing you know, that's going to gravitate toward a lot of other PRs that look very similar or to that effect. So you'll see a 1-2 month stretch of a similar PR that's really trendy, so to speak. So watch the trends. The other one that always seems to still be able to catch traders' attention is when X person, whoever it is investing into that company. And so you'll see and that PR comes out, and it used to be like, of course, the old school name would be like a Warren Buffett, but you'll see like in there for a while it was Elon Musk is doing this, but watch for that when you see a certain person, like I forgot what one I saw recently. I want to say it was CEO of NVIDIA or whatever it was buying into a company, and that thing went, I wouldn't say ballistic, but it had a good spike. So yeah, generally speaking, like we've talked about, just trade the chart, most of these plays, and I've seen even in the past, we'll even have that trend happen from 22 to 23 where we had really good PRs that were put out, but nothing was really spiking nor holding its gains. I had people coming over and saying, okay, this had phase 3 positive cancer, blah, blah, blah. And it was a positive phase 3, whatever the cancer was that they were helping, and it had 90+% results. And that play would barely go up, and then it was tanking back down and then red for the day. And you'd be going, and I'm like, hey, that's like you said, I'm just taking the short, trading the chart, and here's what's going on. But then notice those trends. So that's the two things you'll notice with Catalyst that sometimes will go for a month, 2, 3, or sometimes longer. So like we've talked about, don't go against the trend. The trend is your friend.
Yeah, and the percentage gap that it already had. Maybe they did come out with the phase 3 trials, but they just gapped multiple hundreds of percent. So it's only inevitable that it's going to profit take. But the sector sympathy brought up a very good point. Like, and we've seen that a lot in small cap land here recently, where they're all turning into these Bitcoin treasury strategy companies. Yeah. That headline's been just surfacing everywhere.
And then it plays part, and then eventually you'll notice that but then people still are trying to put that PR out. But yeah, that's definitely a huge one. You'll notice that. Well, the first one I noticed, and I've always brought this up, was 2017. Everyone was moving over to Bitcoin blockchain technology in December of 2017, and you can look it up. It's Elfin, L-I-L-F-I-N. Go look it up. December 15th, 17th, somewhere in there, went on a crazy run. But I remember it was about the 5th, 6th, 7th, maybe even the 10th play that came out with that, and it was just one of those things where you said, watch out for this PR, and it for all December 2017. It lasted about a month, and then it kind of died off into January 2018. But it was almost every morning you couldn't wait to see who was going to put out they're moving to blockchain technology, just looking for blockchain in the PR, and you would see a bananas run. And then speaking of, we've talked about those T12s. Oh, Elfin went into a T12 later into January of 2018 for however long. And that's actually the one time that I knew a trader that was actually stuck in a T12 hole.
And those are halts that last for months, traders, as they're doing investigations into the company and that abnormal movement. So they're very bearish. You don't want to be involved in those. But traders, there's a lot of different scanners out there. I mean, there's so many different scanners, but we need to narrow in that watch list. So building the watch list. And how do we do this? One thing I do, I'll take a look at, okay, the previous runners for the last 5-10 days, and just take a look and see which ones are kind of the low-hanging fruit, which ones are hanging up there still with low volume at this point. A lot of volume to low volume still up there, and normally they don't get the continual momentum. I short for the fade, or which tickers are getting the hot PRs today, the leading gappers on the day, and then identifying certain levels on the past chart history. This is how I build my watch list. I'll pull up the gappers as well, and I'll take a look left and see, okay, where's a ceiling of resistance? Is this nearing like the 200-day moving average? Is it nearing that ceiling? Where's like the liquidity zone essentially? Because oftentimes these will move to those locations, and then we can either ride them on up on the long side or short them there at the top as they bleed back on down. But we certainly, before the bell opens, we want to narrow in that watch list as much as possible, because we got to KISS this. Keep it simple, stupid. We can create way too much noise for ourselves. Josh, I'm sure you've seen that a lot over the years. Like traders, as they're looking for the holy grail, they're focused on too much noise. We got to really narrow in the focus.
Yep. Kind of happened too much. Of course, like I always compare it to, I'm sure you've heard this, and imagine if you're watching these and you're 6 in now, how many times I said the stock market, when you first get into it, traders remind me, JG went with commercial. It's my money. I need it now. So to me, they have that basis of, I just tell me where to buy and tell me where to sell. And then once you actually do start doing it on your own, and you realize you are on your own, even if you are following a guru or in a chat room, all that noise, that white noise that gets brought up, and it is a lot, from the level 2, the time in sales, to you can go through the ringer of how many things your mind starts going over, and you need, again, keep it simple, stupid, which a lot of traders do not. And I did it first. And like I was saying earlier on the live stream, actually earlier on the call-in show, I wasn't trading pre-market. I was like, that's going to be a little too hard for me. There's a lot of limit orders I got to do and get in right at the right time. I'm like, let me just not worry about pre-market. Let me worry about in-market and find where my good time to trade was. All I did at first was have a journaling system of not only my trades, but what time of the day I was trading, what setups I was trading. It took me literally about 2 months. And I said, man, looked at the data here that was in front of me and realized that I was not good trading at the opening bell of the first 30 minutes. And I also was not good at breakouts, which that's generally what I was trying to trade in the first 30 minutes. And I realized if I set back, like we talk about waiting for trades to come to me and be a bounce trader, that I actually had a good win rate there, and I could make that even better. So I did this every morning. I'd come in about 45 minutes or so before the opening bell and make my A list. What was the A play? What was my B play? And what was my C play? Because I didn't want to focus on 80 tickers. I just needed 3. And so I had A, B, C, baby. And then what happened was sometimes A wasn't great. C was better. Why was C better? Why was that back burner play better than what I thought was the A plus setup. And the more you identify and go through those every single day of why A, B, C, and I did this in pre-market. I call it pre-tracking, pre-journaling, and I'd write down and think what I thought A would do and B would do and C would do, and I'd go back through and every day. And then more and more as I did it, that C play maybe would become an A play, or the A play would then become a C play because I was realizing and seeing things that I wasn't seeing before, because I was doing all this data collecting. That's what you have to do, but that's exactly right here. You have to narrow the list. 1 play, 2 play, 3 play. What's your A, what's your B, what's your back burner? And then when you are done trading for the day, you need to go back over A through C to realize what was an A, what was the B, and what was the C.
Yeah, absolutely. And that's what I do too, Josh. The pre-market trading, I've tried it. The back testing says problematic, so I don't do it. And that increased volatility at the open certainly can skew the results as well. So I admire that. You're waiting again for those trades to come to you. And then, like you said, with the C, setups may turn into A. Yeah, and that may be due to the volume, right? Like the volume, we're circling back to that, is critical, guys, for some of these setups. We need volume that creates the range. The range prints the profit, essentially. Right. Without it. And it has to be abnormal. You can look left and see on the daily chart, okay, this ticker had X amount of volume on this day. So how much volume did it have in its past chart history? What was the range the same day that it had that level of volume? And you can see how far it moved from open to close. And it gives you an idea. I mean, it lets you look into the personality of the ticker. Josh, I hardly trade IPOs. For me, it creates a random dynamic to the trade because I like to get an idea of the personality of the ticker. I want to see what this ticker does when it has this volume because it allows me to see into the chart. I can see what's predictable nature of it. With the IPO, you don't have anything. I mean, you have that day alone.
Like a ghost. I don't know you.
Yep, exactly. So having several different setups, the A, the B, the C, and focusing, guys, on the process. That's our last episode, not the profit. So we want to be process oriented because like Josh said, your setup A may not work out, but that's okay. It's not supposed to work out every single time. You just have an edge. That's the nature of this. We want to have an edge. It's not a guarantee in the trading. So the technical setup confirmation is something, as we kind of even narrow in our focus further, we can quickly glance at these charts maybe after that initial volatility, and these setups start developing, Josh. So you have those setups there, and now you got the flags developing. The VWAP support, maybe it's holding 9, maybe it pops up to the 200 day, which is an area I like to short at. So it just, the trade's coming to you. You don't have to experience that FOMO, guys. You create the list and just be disciplined enough to have uncommon patience, uncommon discipline. That's what separates the best from the worst, traders. I'm telling you, if when we narrow this in our focus here and we don't equate more activity to more progress on our trading accounts, it's gonna have very good implications on your bottom line performance in your trading account.
Big time. Yeah, 100%. Yeah. And I love it. That's what you're like, especially when you see that, which at first, a lot of the time you don't get to see the setups form. You want to just trade. It's going up. It's going down. You want to trade momentum, which is really funny. I know I don't really get that. I do, on which we talked about, my 35 to 50 rule and such. There are times for that for sure. But listen, sit back, wait for trades to come to you. Be a stock sniper. And that is the cool thing for me. Like I would do that and wait 30, 45 minutes after an opening bell and actually see a picture being painted in front of me, as I always called it. And I'm like, wow, here's Bob Ross painting me a gorgeous picture here and just slowly talking to me. We'll put some little some forest green over here, all the different colors he used, and that's what it is. And that became that way for me, where I could just sit back and it was like I was watching Bob Ross. And if you go watch that, the great show that he had there for the longest time, you were nice and calm watching it, right? And that's how I like to trade. And so I was like, man, let's just sit back, watch the picture being painted, maybe put on a little Bob Ross in the background so you calm down, you hear him talking to you. But that's what I wanted to do at first. I started to finally realize that. I was like, man, don't attack, don't attack, don't attack. This isn't, I know you go by AK-47, but that is not the kind of weapon you need to use in the stock market at all. And so I was like, listen, let me narrow this down. Let's be a stock sniper and focus in on wait for these setups to form. And then some are going to be different. Some like to play the flags, whether it's inside of the flag in the channel or the break or crack up. Same thing for the VWAP. You going for bounces on it or the crack of it. That's what makes this so special in the end. There's so many different ways for you to trade. And someone actually in the one-on-one asked me that yesterday, because I don't. They're like in there showing they had a beautiful downtrend and had a gorgeous channel just going in the downtrend, bouncing off of it, failing at it. And wanted to confirm you don't trade within the channel. No, not a big channel. That's just not me. I don't like it. I'm not comfortable in it. It just doesn't fit me for whatever reason. Is there money to be made there? 100%. But I don't like it. It doesn't fit my style. So I just wait for the crack or the break of it. But that's where and what defines this being so awesome. There's so many different ways to profit here, but you have to wait for these, as I always say, technical sound setups, technical setups. lead to the best, most profitable, easy base hits you'll ever have in the stock market. Now, again, using that word easy, no, I know, but these will end up feeling easier for you when you watch and see a setup, because you're actually seeing something being painted for you to trade.
Yeah, guys, you can make trading easier, right? I mean, the corny old saying is, right, you choose your hard, right? It's hard to lose weight, but it's also hard to be fat. You know, there's choose your hard. It's hard to be a disciplined trader, but it's also hard to not be a disciplined trader, because guess what? Your equity curve is not going to be going in the right direction. Waiting and sniping, and that's going to come with experience. We're going over a lot of things here that's really just going to take some time for you guys to develop along your trading journey, and that is clearly the good setups from the bad ones. But the experience through you creating these watch lists, and just know and narrow them down and have the setups there, and wait for them, because everybody can recognize these flags, guys. Technicals are a portion of it, and everyone can recognize them, right? So you can see the flags, the head and shoulders, the knees and toes, all the patterns that develop. You'll see them, and they don't work 100% of the time. I call bull flags, for instance, Josh, like bear flags when they're up multiple hundreds of percent, because
Right.
you know that's like the liquidity trap. When I first got into trading, dude, I was doing that. I was like, oh, buy the flag breakout. This is so easy. Like, I see this pattern right in front of me. And then you buy it, and then poof, you know, big upper wick, elevator down. That's the liquidity they're dumping into you. And that's because, like I just mentioned, the percentage up. Maybe it was that phase 3 trials that were released that were positive, but we're up 500%, and it has a bull flag in it. That's the liquidity trap. So this is experience over time, what you guys are going to learn through your own personal trading journey. But we're here to lay out the blueprint for you. We each individually have to build the house. That comes to our final little point here, traders, which is plan the trade, trade the plan. You've heard it before. You gotta have that plan, traders. You scanned, you did your pre-market analysis, you narrowed in your watch list, found what the catalysts are, have the ABC setups. Now, which ticker is going to get the volume, which ticker is not, and just trade it objectively. Build the watch list, and now it's time to execute. And that's another part of it, right? A lot of traders have a hard time even just executing when they have the trade. So now we have the setup. We got to execute on it to put ourselves in the favorable position for the outcome.
Yeah, no, and that's what you have to do. Just do your due diligence every morning. Like, I'd find my early process of what I did, and just continue to do this day in, day out for years on end. That's what then becomes a good habit you've built up. You've got to build these good habits to begin with. Of course, you're probably going to have some bad ones you do may tend to build up, and you'll have to get rid of them. But that's the key. If you don't, if you're especially if you're very new at this, you probably don't have any bad habits built in. So all these episodes, all this we're telling you, just do what you're telling you, and you can easily build up a nice, good habitual thing to, in my opinion, a positive one, because not many people build positive habits when it comes to stock trading early on. They build some bad ones, whether there's many things we've talked about the bad habits, right? Whatever it is, holding too long, scaling up too much, etc. But then this is where it comes into, like we've talked about so much, the mental state of mind, which really gets negative the more these bad habits build up, because you continue to do these bad habits, which leads to losses. And so, like we said, every morning, make it simple like I did. I come in, I find my A, I find my B, I find my C. I trade my A, and I sit, like today was AMD. Truth be told, that was my one trade. I didn't like what I was seeing in small caps to open the bell today. I wanted AMD in a crack of a certain area. It never actually gave me that crack until it did finally later on. But I wanted a crack of, say, it was, look it up today, 234. Today is October the 9th. Just so you know, today is October the 9th. So go look up AMD. I wanted the crack of 234. It never gave to me, kept bouncing off of it. But I wasn't going to be stubborn, switch around and say I wanted to bounce at 234. I wanted the short of it. But what did I do? I was patient enough to find a new pattern, which was reversal at high of day. It went to 240, failed at 240, and has now come all the way back down to 230. So what did I do? Take the reversal at 240. I got my trade in. I stayed on AMD. I changed because I'd been doing this long enough to adapt and adjust to what was going on in the stock. Still got my short I was looking for. And then when it cracked 234, voila, you get your second trade. It's about discipline. It's about patience. It's about sitting on the ticker that you want to trade. And again, if you do that, you will be a successful trader. It's doing the squirrel that will lead you to losing a lot.
Yeah, we go over it. Random trading equals random results. So narrow it in, traders. And when you stick to the plan, traders. When you adjust it mid-trade, like we so often do, you're just like taking that stop and actually here, no, here, no, here, no. Actually, I'm a long-term investor now.
Yeah.
this was meant to be a little scout, Josh. Now I'm like, okay,
I thought I was just gonna take her on a date to McDonald's, and next thing you know, I'm married to her, and we've got 10 kids.
yeah, exactly. You're all into this ticker. Married her.
Yeah.
Well, guys, that's what happens. That's what happens to a lot of traders. So that's why you cannot adjust the risk parameters mid-trade. Stick to the risk, plan it out beforehand, and trade that plan. Doing it all in pre-market analysis. And now, traders, it's time to execute on that plan. But that was this episode, guys. Thank you for watching, and we will see you in the next one. Bye.